I think it's pretty well understood in the literature that news coverage is indeed predictive of returns. So when stocks appear in financial news, like in the Wall Street Journal or in the New York Times or Financial Times, then these stocks tend to perform abnormally or perform differently than what we would expect. And there's primarily what we have learned from the literature is that this is primarily due to a behavioral reason. So the mechanism goes something like this. Well, investors are constrained in their attention capacity and the information processing capacity. So when something appears in the news, it draws their attention, and therefore investors will tend to trade differently these stocks that appear in the news. We have papers by Barbara and Odin, Engelberg and Parsons and Perez that show that stocks that appear in the news tend to be overbought. So they have buying pressure. And ultimately, because these stocks then are traded differently, they also have different returns. So Hillard and Ungeheuer and their co-authors have several papers on this that show that stocks that appear more often in the news, even after accounting for, say, their size, will tend to post higher returns and also face stronger momentum. And ultimately, we also, in another research paper that I've done and that Ken Ahern has also done, we show that when stocks appear in the news, investors overreact to information, and that leads to predictable reversal patterns in returns data. Now, all of these papers together, what they really posit is that coverage is predictive of returns primarily because of a behavioral reason. What that really implies is that news coverage per se is uninformative about risk characteristics. When something appears in the news, it's primarily because these are large stocks that are going to draw a lot of attention to these news outlets. And therefore, we don't really learn much from news coverage other than just it drives investor attention. Now, recently, there have been two theoretical papers by Niemark, Pitchner, and Schauer. And what these theoretical papers argue, really not so much in a financial setting, but more in a macroeconomical setting, is that there is possibly an alternative channel that's purely rational. And the channel goes something like this. So consider a market for information, where there are attention-constrained investor agents on the one hand that need information to make decisions. And then there are news outlets on the other hand that are for-profit businesses. So they need to draw readership to be able to generate revenue. Now, in the equilibrium of this market, what happens is that agents are going to willingly delegate the collection of information to news outlets, and news outlets, in order to attract these readers, are going to report about the events that the readers care the most about that are going to lead to the best decision making. So in this equilibrium, agents delegate the collection of information to outlets because they know that news outlets are going to point them to the pieces of information that they should pay attention to, and news outlets are going to do precisely that. Now, when we translate this equilibrium basically to a financial setting, what we conjecture is that financial news outlets are going to choose to report about the events that their readers care the most about. Now, the readers of financial news outlets are investors, and investors are risk averse. So we posit that what appears in the news precisely because it draws the attention of risk averse, attention constrained investors. And those are events about risks. So our argument is that there's possibly an alternative channel that posits that news coverage data is informative of future returns because basically it highlights to attention-constrained investors assets that are risky and carry high risk premium. Now, what we're going to do in this paper is we're going to precisely try to disentangle both of these channels. So what we're going to do is we're going to ask, why does news coverage predict future returns? To which extent is this due to this traditional behavioral channel that posits that news coverage is uninformative about risks? And to which extent is this due to this new rational channel that posits that news coverage is predictive of returns precisely because it highlights risks? Now, the answer to this question is really important because it expands our understanding of what's the informational content of news coverage data. Now, to disentangle both of these channels, what we're going to do is we're going to introduce a new measure that we call editor preference. And our measure of editor preference is going to measure how much more likely a stock is to appear in the news than a baseline firm of similar size, analyst coverage, and prior coverage because of its risk characteristics. So if you want to think about it, you can look at kind of this formula below. What we implicitly assume is that the decision at financial outlets to report about a stock or not to report about that stock depends both of the size of that firm, that is well known that firms that are larger are more often in the news. It depends on the analyst coverage of that firm. There's some evidence that argues that news coverage is complementary to analyst coverage, so therefore we would expect some relationship here. And in addition, coverage decisions tend to be pretty sticky, so we're going to control as well for this prior coverage history of these firms. Now, what we bring to the table is that we argue that the decision to cover a stock at a financial news outlet will also depend on the editorial preferences for different types of risk characteristics. So we're going to define these editor preference as a function of different characteristics that may be associated with returns. And we're going to try to measure that in the data. How much more likely is a stock to appear in the news because of its risk characteristics? What I'm going to show you is that these editor preferences that we extract from financial news data are a timely and comprehensive measure of risk. We're going to estimate them using New York Times data going back to 1995 through to 2015. I'm going to show you that these editor preferences are highly time varying and driven by risk characteristics like factor betas, volatilities, and leverage. In addition, I'm going to show you that editor preferences are really a measure of firm level priced risks. And these are timely measurements of risks. I'm going to show you that, for example, editor preference predict future stock returns at the firm level much more accurately than in the individual characteristics that go into the measurement of this firm, into this measure. Now, to really understand what's going on, I have two examples here. So in the bottom, these two plots display the estimated editor preferences for two firms, Citibank on the left and Goldman Sachs on the right. And you can see that these measures vary around a lot. Now, the way to interpret the measure is that e to the power the editor preference is roughly proportional to the factor with which this stock is more likely to appear in the news. So if you look at this left plot for Citibank, during the financial crisis, editor preference were around 1. So that means that e to the power 1 minus 1, so it's a factor of around 2. Citibank was 2 times more likely to appear in the news than a firm of similar size, similar analyst coverage, and prior coverage history. In contrast, on the right, Goldman Sachs was only around 50% more likely to appear in the news during that time than a similar firm. So what you see here is that these firms, even though they're relatively similar, have different editor preferences. And as you know, and as we have all witnessed, Citibank was, of course, at much higher risk of failure during the financial crisis than Goldman. And we argue that this is precisely why Citibank was more likely to appear in the news. What I'm going to show you as well is that these firms that have high editor preferences perform abnormally well in the data. So firms, if you build firms that have high editor preferences post higher returns in the next month, again, suggesting that this is a measure of risk. And if you build a long short trading strategy based on these editor preferences, where you go long on the strategies with the highest editor preference score and short on the stocks with the lowest editor preference scores, you can generate alphas of up to 15% in excess of risk factors. We find that no single factor or characteristics explain this anomaly, so it's really due to the time variation in the selection of financial news. Now, we're going to use our measure of editor preference as an instrument to disentangle the behavioral and the rational channel that posit why news coverage is predictive of future returns. And what I'm going to show you is that both of these channels contribute almost equally to the predictive power of news coverage. The way we're going to do this is by controlling basically the coverage strategies when we include firms with high and low editor preference scores or exclude them. And I'm going to show you that the alpha of the coverage strategy shrinks by almost 50% or even above 50% when we exclude these high coverage firms. So what our results really show is that news coverage data is predictive of future returns, partially because it drives investor attention, and as was established in the literature, but almost to equal extents because it is a signal of price risks. So there's a lot of information contained in news coverage data that we really haven't tapped into. All right, so now let me walk you through how we obtain these results. So what we're going to do is we're going to run cross-sectional regressions every month within the universe of the largest 500 firms in each month. So what you have here in a regression setting is that the dependent variable is going to be what we call coverage, which is the logarithm of 1 plus the number of times that stock appears in the news published in that month. And we're going to regress coverage on firm size, on analyst coverage, on an indicator that marks whether this firm was not covered in the previous month. And then we're going to add basically these firm level characteristics. Now, the literature so far has mostly done these kind of regressions where they regress basically coverage on size, coverage on analyst coverage, or coverage on prior history, and establish that, yes, firms with large size appear more often in the news. Now, what we're going to do is we're going to add these characteristics over here. And because these regressions are re-estimated every month, we're going to get time-varying loadings basically on these characteristics. The time variation in these loadings are really going to be the piece that is going to be informative basically about future returns in our setup. Now, the characteristics that we're going to include lag returns. We're going to add the 3 months cumulative return, idiosyncratic volatilities, leverage ratios, EPS, analyst forecast dispersion, the number of analyst upgrades and downgrades, as well as the betas in the 4-factor loading in the 4-factor model of Carhart. So it's going to be the beta with respect to market size, value, and momentum. We're going to re-estimate these coefficients every month, these regressions every month, and then we're going to call our measure of editor preference. We're going to define our measure of editor preference as basically the projection of coverage on these characteristics that drive firm performance, basically. So editor preference is going to precisely capture how often a stock appears in the news, how much more often a stock appears in the news than a similar firm of the same size, analyst coverage, and prior history because of these characteristics. We're going to estimate this model using New York Times data. So we've built our own scrapers for the New York Times financial section. So we cover the business and business day sections. The New York Times is freely accessible through their archives. So this was a very easy way for us to get data. And then we're going to run algorithms that we've developed ourselves to identify in this text where firms are mentioned and how often firms are mentioned. And then we're going to complement this data with standard data from CRIS, CompuStat, and IBIS. So here I'll show you basically what these coefficients look like on the characteristics that drive editor preferences. And you can see that these coefficients vary significantly over time. We standardize everything in the data. So everything here is also in terms of teeth. You can think about these as teeth stats. And for example, you can see that leverage is always a significant predictor of, or almost always a significant driver of editor preferences. So the news will tend to report more often about firms that have high leverage. What we also see is that prior to the financial crisis, the news would tend to report more often about firms with negative cumulative returns. Since the financial crisis, this has reverted a bit, and the news tends to report a bit more often about firms that have high idiosyncratic volatilities. Can do the same by looking at the factor betas. We find that during the financial crisis and after the financial crisis, the news tended to report a lot about, or more often about, firms with negative exposure to momentum. And since the financial crisis, the news has tended to report more often about firms with positive exposure to the size factor. So you can, the way you want to think about this is that, say, on average, we find that around 25% of the top 500 firms are always reported in the news. But the composition of those 25% changes over time. Sometimes the news reports more about firms with negative returns. Sometimes they report more about firms with positive idiosyncratic volatilities. And other times they report about firms with negative exposure to momentum. Now, what we want to do is we, of course, want to sort firms according to the estimated measure of editor preference. And if you sort firms by this and then build your standard quintile portfolios, you will see that indeed firms that have high editor preferences in 1 month post higher returns in the next month. So these portfolios are very well sorted, with the high quintile portfolio performing much, much better than the low quintile portfolio. Now, this is obviously a strategy you can run. We argue that this possibly is not the strongest strategy because it doesn't really exploit the fact that coverage is also predictive of returns. So the way you want to think about this here is you want to think about the set of firms that we're considering in any given month. So out of the top 500 firms in any given month, around 25% are covered in the news and 75% are not covered in the news. So what the literature has always considered is basically the discrepancy between covered and non-covered firms. And we have that covered firms tend to perform better than non-covered firms. Now, what we're doing is we're looking at firms with high editor preferences and low editor preferences. Now, what we posit is that editor preferences is a measure of risk. And therefore, these firms with high editor preferences are going to be the most risky firms at any given point of time. And the firms with the lowest editor preferences are going to be the least risky firms at any given point of time. Now, if our theory is correct, then the intersection of coverage and editor preference should give us the highest spread basically in performance. So if we look at the firms that are highly risked and covered, these are basically the most newsworthy stocks in the universe of firms. These are stocks that investors want to know about. So that would be here, this green intersection over here. These stocks we posit would be the firms that are going to post the highest return going forward, partially because they have high risk and partially because they are going to experience basically inflows due to the behavioral channel due to coverage. Over here, the orange shaded line, orange shaded area are the least risky firms that are not covered. So in a way, these are the least newsworthy firms. These are the firms that are going to tend to underperform relative to all other firms. And if we look at the spread basically between the green shaded area and the orange shaded area, that should give us the highest predictive power or the highest performance in long short terms. We evaluate that precisely in the data by running standard factor model regressions. And we find that indeed that green minus orange shaded area posts an annualized alpha of 8.28%. We find that the high coverage minus low coverage strategy only posts around 3.4% alpha, and the high editor preference minus low editor preference only posts around 5% alpha. Now, nothing in what we've done so far is really restricted to these 500 firms that we consider any given month. We only use the 500 firms to estimate the model of editor preference because the 500 firms coverage is anyways concentrated on these super high firms. And therefore, if we were to consider a larger universe of firms, we would just get a lower statistical power. But we can extrapolate basically this model to a larger set of firms. And when we do that, what we find is that the predictive power of editor preferences grows basically as we extrapolate the model to a wider and wider cross-section. When we consider the widest cross-section that includes basically all publicly traded firms in the US, that covered high editor preference minus non-covered low editor preference strategy posts an alpha of 15% per year. So this is very strong predictive power in excess of risk factors. What's also really interesting is that this is not a market neutral strategy. There's significant exposure to all the risk factors, again, suggesting that this is a strategy that is loading on risk as well. So this is not just basically a pure statistical arbitrage story. Now, what we want to do is we want to use this measure of editor preference now to disentangle the behavioral and rational channels. But in order for that to work, I really have to show you that editor preference is an instrument that controls for if a firm is reported on because of its risk characteristics. So what I'm going to show you is I'm going to show you a set of results that argue that indeed editor preference is a timely measure of firm level risks. The way we're going to do this is we're going to first consider basically an elastic net regression of abnormal returns at the firm level regressed on a bunch of different characteristics. So we include all the characteristics that we use to compute editor preference and size and earning analyst coverage. And we also include then our editor preference score. Now in this regression, of course, everything is collinear because the characteristics go into the editor preference score. But by using this elastic net regression where it penalizes basically when too many parameters are significant, we're going to circumvent this issue. Now, what we want to study is how significant is editor preference of a predictor for abnormal returns after controlling for all these characteristics. And the way we're going to assess that is by making the elastic net penalization larger and larger to make many of these parameters shrink. What we find is that editor preference is basically one of the few predictors of firm level returns that survives as the penalty becomes really, really tight. We find that editor preference dominates most of the other characteristics that go into the evaluation of into its construction. So this again suggests that indeed editor preference is predictive of future returns at the firm level, suggesting that this has something to do with risks. We also find that editor preference is a comprehensive measure of risk because it encompasses many different characteristics that are possibly predictive of future returns. We find that if we were to build long-short strategies restricted just to, or projected just on the individual characteristics that go into evaluating editor preference, then we wouldn't get the predictability that we have here. So one of the reasons why editor preference is predictive of future returns is because it encompasses many different risk characteristics, not just a single risk characteristic. And then finally, we show that editor preference is a timely measure of risk. If we were to consider a static measure of risk, where we take the time series average of these coefficients, of the editor preference coefficients on the characteristics, then we wouldn't find any significant alpha, suggesting that editor preference is informative of future returns because it basically weighs these different risk characteristics differently at different points of times. So the time variation in the signal is really important. So then in the end, what we're going to do is we're going to now disentangle what we started out with. We wanted to understand why is news coverage predictive of future returns, and we wanted to disentangle the behavior on rational channels. So I'm going to show you some results here that are hopefully going to be informative for you. So the first thing we're going to do is we're going to decompose basically the alpha or the performance of a coverage strategy. So the traditional in the literature, strategy studied in the literature goes long on firms with high coverage and short on firms with low coverage. Often these strategies are in terms of raw coverage, so just counting the total number of mentions in the news. And other times people consider residual coverage in excess of size because we know that large firms appear more often in the news than small firms. Now, what we're going to do is we're going to decompose the performance of that coverage strategy into three different components. One component is going to be the editor preference component. And then the other two components are going to be the residuals of the firms with high coverage in excess of the firms with high editor preference, and the residual of the firms with low coverage in excess of firms with low editor preference. So what this analysis is going to show you is going to tell us is how much of the predictive power of coverage comes from editor preferences. Now, in graphic terms, we find that the vast majority of the predictive power of coverage comes from editor preference. And it is not a very rigorous analysis because it's not all these terms are positive, but the green area here shows basically the editor preference spread, while the black lines shows kind of the coverage spread. And you can see that these are closely tracking each other. Now, we find some evidence that firms with high coverage perform better than the firms with the highest amount of risk as measured by editor preference. This is kind of consistent with that behavioral channel that posits that there are basically these attention flows that will make these high coverage firms perform better than even the most risky firms. And we also find here in this blue shaded area that firms with low coverage tend to post higher returns than firms with the least amount of risk as measured by our editor preference score. Now, that is really a surprising result because it tells us that these low coverage firms are kind of paying a premium. But that is really consistent with a paper that is often cited in this literature as well, Fang and Perez, 2009, where Fang and Perez argue both theoretically and empirically that firms with low coverage should pay basically high returns because this is basically a way to attract investors' attention. So we find some evidence that reconciles the findings of Fang and Perez, even though those findings are really hard to replicate in other data sets other than the one in Fang and Perez. So graphically speaking, what this tells us is that the vast majority of the predictive power of coverage comes from editor preferences. Now, to really quantify how much of the predictive power comes from editor preferences, what we're going to do is we're going to do basically factor regressions for coverage long-short strategies, where we consider either raw coverage or residual coverage. And then we want to see by how much does the annualized alpha shrink when we include or we exclude firms with high and low editor preferences. So here, if you wanted to think about it in this plot, what we would do is we would look at the strategy of covered versus non-covered, what we would include or exclude these shaded areas to see how much of the performance comes from those shaded areas. Now, what we find is that when we exclude these abnormal editor preference firms, the alphas of the coverage strategy shrinks by 45 to 70%. So that tells us that around half, but almost up to 70% of the predictive power of coverage comes because of editorial preferences as measured by our signal. So that tells you that the news coverage is predictive of future returns almost to equal extents because of that behavioral channel that just drives attention and the rational channel that posits that coverage is a signal of risk. So that brings me to the end of my presentation. So what we show is that news coverage is predictive of future returns roughly to equal extents because it drives attention through a behavioral channel, but also because coverage is a signal of risk in an equilibrium between attention-constrained investors and for-profit news businesses. The way we establish these results is by introducing an instrument that measures how much more often a stock appears in the news because of its risk characteristics compared to basically a firm of similar size analyst coverage in prior history. This measure we call editor preference, and it's highly time-varying and predictive of future returns. And overall, what the results of our paper really show is that there's a lot of information contained in news coverage data beyond just attention flows. And we should really look more carefully into what's contained in this data. That's it. Thank you so much.
Thank you. Thanks to Gustavo for the great presentation and impeccable timing. So the discussant is Fuwei Jiang from Central University of Finance and Economics. Fuwei, the floor is yours. Yeah, thanks.
First, I want to thank Gavin for inviting me to discuss Gustavo's super interesting paper. Okay, I'm enjoying a lot when reading this paper throughout. I do learn a lot. To briefly summarize what this paper is working on, basically this paper constructs a novel measure of editor preference. The author will argue this measure captures a stock's risk rather than attention or sentiments, the popular behavior motivated stories. In other words, this paper provides a risk instead of behavior view on media. Okay? This is in this sense, it is a highly interesting paper. It's novel, it's different sharply from the popular view in the literature. The author also show the editor preference measure constructed in the paper is a powerful predictor for future stock return. Like they stated in the abstract, and the alpha can be 15% a year. Okay, I will think maybe this number is too big to be true a little bit. There's some minor issue. For example, you're using equal weighted way to construct the portfolio. Also, I will discuss later, right? The 15% alpha is a mixed coverage with editor preference. Anyway, even after considering these minor issues, the result in this paper is still strong. The story is novel. It's a great paper to read. Okay. Then I will turn to my discussion. Sorry. Okay. Now it's like some more critical. Okay. First, let's back to the measure of the story of this paper. Basically, the paper starts from the literature on media coverage. Okay. They give a model. Okay. Motivates to actually the media coverage is not random. There's some economic reasoning underlying journalist or editor's choice or decision in which firm to cover and which story to write. It's somehow like when we write academic papers, we didn't write paper randomly. We make thoughtful decision. Okay, this is the same process. The paper decompose this media coverage decision into, like, for example, the popular view, like size matters. Media tend to cover like Apple, Tesla, instead of some like small minor firm in nowhere. Analyst coverage. Okay, this is I think maybe there's a moment, right? Given a big shock like COVID, it may have a big impact. Then all these market participants, including journalists and analysts, may tend to cover together. Okay. Also, there's a cost sharing problem. Also, there's a sticky or momentum. Momentum is everywhere, including journalist decision. For some reason, I think one may be lazy, right? You already know it a lot. It saves you time and effort. Also, some consider some connection, social network, or they have an easier way to gather information. The cost will be lower. The information processing ability is stronger for the similar firm. Okay, this is what documented well in the literature. However, beyond all these well documented and the reasonable stories, this paper shows that another novel dimension is editor preference. Okay, editor itself can play a role in this process, especially the paper argued editor preference. This is a risk measure. Okay, instead of like a pure attention measure or sentiment measure, they argue this is a risk measure. This measure as a risk measure somehow is mechanical because it's the way the author constructs the measure. Okay, actually, the model editor preference as a function, okay, as a function of firm characteristics, especially those characteristics related to risk, such as volatility or beta. Okay? We will discuss it later. Okay, I think this figure is informative. They show that, for example, the coverage itself is differently from editor preference because for example, the blue circle is media coverage. However, the green circle is the editor preference. There's some overlap over there, but we will find majority is not overlap together. Okay, this is also related to the expected versus residual decomposition the author discussed in the paper. But in summary, what I take away is editor preference is related but different from media coverage. Okay, this is some new information there. Okay, but back to the measure. Okay, however, what we know is media coverage is indeed informationally sparse. In the paper, the author show only 20% firm among the 500 biggest firms is covered, right? I think this number is a little bit exaggerated this result. Okay, you might also consider like the top 1,000, the top, even top 5,000 of the full sample from to show the dynamics. Okay, what I expect is that only a small portion for firm are covered by the media. Okay, I know this is a self-selection problem in the media coverage process. However, it will a little bit complex your story, make the story more complex because we given only small portion from a cover, right? Risk should be everywhere, should be systematic, but coverage itself is not pervasive. Coverage is selected. Okay, this somehow actually I just quote some paper I'm familiar with, like the text selection paper, which I used to replicate the paper previously, because you see in this paper, see, this is not about the coverage, it's not about words. Okay, even for words, you see, majority words only have 0 or 1 appearance in Wall Street Journal. Majority firms are not used. Okay, back if the author actually the textual selection paper, they give some justification for this process, like because there's a counter over there. Like we turn back to the firm's coverage. Okay, the editors may try to counter the investors' demand. When the investor need more, maybe about risk, maybe about sentiment. The reader want to read more due to risk shock or sentiment shock. The editors provide more service. There's some endogenous over there. Also, it's back to the production process. There may be some cost sharing or some like learning by doing process. Okay, the path dependent over there for this decision. Okay, this or however, like the editor preference function used in the paper is more reduced form without too much structure. Okay? If we can give some structure for the economics underlying this variable, I think it's much better. Also, why I mentioned coverage, right? Back to the paper, the author argued they have a 15% alpha, right? In the the bottom. Sure, actually, for me, I will think maybe 4% is more reasonable because the 15% alpha combine both editor preference and the coverage. They mix you mix 2 factors together, right? But again, coverage is complex. You cannot fully argue coverage is a risk process. Then this 15% alpha is driven by 2 factors. We cannot mix it, right? Maybe even 4% is large enough for me. It's not necessarily 15%. Back to the editor preference function. Editor preference is a function of a firm characteristics, such as idiosyncratic volatility, leverage, or betas in the literature. Okay, this paper given is very well. Okay, however, given this function form of editor preference indeed is a linear combination of characteristics. Okay, however, there's some literature you should think carefully, because like there's a recently the highly influential paper written by Kelly Prusu, they argue characteristics are covariance. Your measure itself is a function for characteristics. Okay, based on this argument, we can naturally conclude, right? Coverage is a covariance. Okay, it just this may be different. The facts doesn't change, but the story change somehow. Okay, because in your paper, you basically using characteristics and measure for risk. This is not true. Right? Characteristic can be anomaly, can be everywhere. There's a debate in the asset pricing literature about characteristic versus covariance. If you follow Kelly Prusu's paper, right, there's another story to tell. Lastly, I'm highly familiar with sentiment literature. Okay, just sorry, a little self-promotion. You're using Baker Wugler's paper, right? our paper show that Baker-Ugler's measure is not the most efficient way to construct sentiment, right? You may consider using our measure, right? Our measure is we tend to update annually. I think it can be a better measure. Moreover, in your paper, indeed, you just plug in the Baker-Ugler sentiment into the Fama French regression. This is not the right way to do it. If you want to include sentiment as a factor, usually using factor mimicking portfolio instead of just using. It's not a time series regression. Moreover, you can follow like the Baker-Ugler or Stem Yuan use way, just do some sample split or interaction. The story is alpha is more pronounced in high sentiment period. Right? Instead of just control the sentiment index, this is not the correct way to do the research. Okay, to conclude, I strongly recommend this paper. I learned a lot. I think this also have some novel and new idea in the mind to try to explore the risk dimension of media coverage rather than the attention or behavior dimension popular in the literature. But this is a challenging task. I think you have a more to do in the future to justify your theory and the empirical process more carefully, because your paper, as paper is novel, the reviewer, the audience are more critical. Okay, thank you.
All right, thanks to Fuwei for the great discussion. So Gustavo, do you want to briefly respond to the comments from Fuwei?
Yeah, absolutely. Thank you so much for that discussion. That was really, really great. Really great points. I've been thinking a lot about this characteristics or covariances things, and I really think that what I'm picking up in these editor preference scores are basically time-varying betas. I haven't really gotten a chance to dig deeper into that, but that's what I feel is really going on. So that would align with that story that these are kind of covariances measured at a much higher frequency way, basically. But that's a fair point. Gotta think about the other comments, but yeah, generally, absolutely thankful for that discussion. That was great. And please send me your slides.
No problem.
Yeah.
Good luck.
Thank you.
All right, we also have one question from the chat. Have you considered adding time-varying firm-specific news to editor's preference? Such factors like earnings price may also affect editor's pick on firms.
Yeah, so we haven't actually done that. That's a great suggestion too. I should look into that. Totally doable. Yeah, so the New York Times used to publish earnings announcements, but then we excluded all of those. So they're not included in our sample, but it would be great to see what happens around earnings announcements as well. Yeah. Then natural question, why only New York Times? We've been getting that a lot. This is a consequence of basically news data being so expensive. I mean, I think a lot of good schools, very advanced schools, have basically access to Refinitiv, and that has a lot of data. But getting access to Refinitiv is extremely expensive. So we didn't have access to Refinitiv, and we kind of went with the one approach that we knew, which was to scrape our own data. The New York Times is a free archive, so we did it with the New York Times. The Wall Street Journal doesn't have a free archive. Financial Times doesn't have a free archive. So we couldn't do it for those outlets. We now do have another data set. We have a Reuters data set that we're gonna exploit and analyze as well. So in the next version of the paper, probably we're gonna include both the New York Times and these Reuters news pieces as well.